Okay, so here's the beautiful thing about the 4M framework. You only have to remember 4 words and they all begin with the letter M. So here's what I walk people through all the time is who's bringing the money, who's qualifying for the mortgage, who is management, day-to-day operations, and then on the last M is who's the master, who is the real estate expert into the transaction. So those are the 4 things you need to negotiate. Today is going to be another one in, one for the ages here. We're going to deliver a whole bunch of value. We're going to deliver a whole bunch of amazing content to help you move forward. Welcome in. Hi, I'm Russell Westcott. I help real estate investors start, grow, and scale the real estate investing portfolio of your dreams. Now, here's what we're going to do today is we're actually going to dive headfirst into one topic and we're going to go deep. The topic we're going to dive in today is talking about structuring our deals. How do we structure our deals? How do we create win-win? How do we help our investment partners win in the transaction and you participate in the win alongside them? Got a really killer presentation here for you guys today. If any of you have been following along over the last, say 5 or 6 weeks, I've been delivering a very in-depth training for you, a masterclass. And a lot of people have been sitting there and I've been getting lots of feedback and people coming back and go, Russ, I can't believe all the value you're delivering for free here. A lot of people will sit there and, jump onto a webinar and they'll, do a little bit of a presentation. And at the end of it, they'll take more time to actually sell you into something than you actually did time of the teaching. I'm here 100% to be of value, 100% to deliver inspiring content, 100% to deliver information and content and implementation for you to help you move forward. So let's do a quick recap. If you've been following along, we started, I think it was probably about 4 weeks ago now, about a month ago, where we started diving in. Part 1 of the process we walked through was, doing a plan. Like, what was your plan? Like, truly, what is your real estate investing plan? And that's one of the things I have conversations all day long, consultations with people is truly, what is your real estate investing plan? Whether you bought into the plan that I outlined for you, or you completely thought it was a bunch of malarkey or a bunch of bunk, right? What's your plan? That's the key thing is, so what is your real estate investing plan? So we identified a plan over a course of time, and the timeline I identified was 15 years. How do you create a portfolio of properties, $1.8 million of real estate to generate approximately about a $92,000 income stream for you in a 15-year time frame? So that was the first step. Step 1 was we created a plan. Step number 2 was we went deep into what are some of the things that are going to stop you. Now, I know some of you might say, Russ, well, that's so negative. What a negative thought process. What is going to stop me? Let's be all positive. No, let's identify what are the obstacles you're going to face in this game of real estate. Let's put them on the table. Let's really just identify them, because I firmly believe if you solve all your obstacles, the only thing left after you've solved all of your obstacles is success. Then we dove into, and remember, during the obstacles, I firmly believe that the 5 biggest obstacles that real estate investors face it spells the acronym of TEAM, T-E-A-M. The first one is a lack of team. You don't have a team to help you move forward. The second one is T stands for time. You don't have the time. The E stands for your education. The A stands for your attitude, mindset. And the M stands for the money to move forward to keep building that portfolio of real estate that you're looking to accomplish. Okay, so then what we dove headfirst into, and it was interesting, during that webinar or during that live broadcast, I asked the question, what is your biggest obstacle that's stopping you guys? And the majority of people will say the money. So then what we did after that, we started diving headfirst into the money conversation. Like, where do you truly find the capital to keep moving forward? Those were what we started. So today we're going to take the next step in the process. And what we've identified is the 4 building blocks of raising capital success. So that's what we're going to dive into today. To just stick around to the end, because I have another 2 amazing free gifts that I'm going to offer to you guys tonight as well, or I should say this afternoon. I'm going to offer some gifts for you that are some very high valued gifts, and it's no cost. Okay, no cost. This is just pure value, pure training, pure solving what some of your guys' biggest issues out in the marketplace. I really get into my work here. So we're going to get right into the PowerPoint presentation. And, I'm going to be the little bit of the bobbing head on the side, and I'm going to do a little song and dance, and I'm going to help you guys keep moving forward. So what we're doing today is remember, so a little quick recap, as we talked about the 4 building blocks of raising capital success. So if real estate, you need capital to buy a portfolio of properties to make essentially own an asset base that generates enough income that you can generate your financial freedom from. how do you get the capital to build that portfolio? Like if I identified that you maybe needed, let's say you needed 9 properties, and some of you might be sitting there going, well, how the heck do I buy 9 properties, Russ? Well, that's the process we're going to walk you through here, is how do you source the capital to buy 9 properties? Or maybe your target's 90, maybe your target's 900. Whatever your target is, that's your target. Okay. So that's what we're here to do. And so far, what we've talked about is we've talked about 4 critical building blocks for success. Part number 1 is you need to generate leads, attract leads. And what was it, probably 2 weeks ago, I went in depth into that about strategies on how to position yourself, how to identify your investor avatars, where these people hang out, the key 100 strategy, who controls their attention, treating it like a business. How do you maybe even use like a CRM database to keep following up, because the fortune is in the follow-up, okay? We treat this like a business. To be honest, those of you, this business of just raising the capital to buy real estate is a business within the business. No different than managing your properties, or no different than doing renovations. The raising of the capital is an absolutely essential part to the business of this real estate investing. So that's the first thing, is where do we generate our leads? So now we get somebody who's raised their hand and said they're interested. Then how do you qualify that person? How do you amplify their desire? So last week I went in depth into, and I actually did a role play for you guys where I walked you through the conversation. Like, how do you have the conversation? One of the scariest parts of the process people feel is having that conversation with your investment partners. I actually went in depth of walking you through that. Here's the questions, here's the sequence, here's how I answer it, here's how I position it, and then when you make the presentation. Okay, so I went in depth, in detail into that conversation with you, and then I offered you guys a killer bonus at the end of that presentation where I offered you my script. Okay, so maybe if you guys stick around at the end, maybe you'll find another way of how I'll offer that script again to you. So today, what we're going to talk about is how do we structure our deals? Okay, how do we we got somebody interested. We know their reasons why they want to work with us. Now, how do we structure the deals? And that's what we're going to go through in depth here. And I can give you guys a really simple framework and a really simple formula to follow. And I think every single person who's watching here today will be able to follow this formula. But before I do dive into the framework of the 4M framework, I have a little bit of some of the teaching side of the philosophy around negotiations, on what you need to have in order to have people that want to work with you. So we're going to talk about 2 things, essentially: the S.E.R.V.E negotiation strategies and the 4M deal framework. So guys, quick time out here. For some of you, if you've been watching along on the presentations and the masterclass I've been sharing with you, you know I'm a big fan of acronyms. Okay, and one of the reasons why I like the acronyms is truly, first of all, everybody can remember them when you teach them. Most importantly is I can remember them too. Like, so serious. If I'm sitting there, all I have to do, if I didn't have any of these slides, or I just needed to have a flip chart, or I just need to get up and give a presentation to somebody, I could deliver this presentation by remembering 3 acronyms: CASH, C-A-S-H, S.E.R.V.E, S-E.R.V.E, and then 4M. So all I have to really learn and memorize is, what would that be? 5, 9, and 5, 9, and 4, I'd have to remember 13 points. That's it. And I can deliver a keynote that could probably last an hour to an hour and a half at least. Okay. Then backfill it with some stories and a whole bunch of wonderful things like that. So, okay, enough of that aside. Let's get right into it. So let's talk about, how do we structure this? How do we negotiate these deals? So what we're going to talk about here is we're going to talk about both the art and the science of deal structuring. I'm going to share with you guys just a framework, a simple framework. But the key thing out of this whole thing, out of this process, is that you become a person that can take this framework and customize it for you. It is no black and white answer to the exact same way you do a deal. There's no actually black and white same way you do a deal from one partner to another. There's no black and white way that you, Jim, and you, Joan, you do completely deals differently. But what I want to do is I want to offer you guys a framework that you can come back to the framework to have the conversation to help you put a lot of thought process into the splits. Okay, that's what we're really trying to do. And my big intention out of this, now, who recognizes this person that's on the screen right now? If any of you have ever watched, I believe the TV show is it The Art of Painting? It's The Joy of Painting. For those of you that if you don't know who this person is, or maybe your age demographic, this is Bob Ross. Bob Ross is truly, I believe, an absolute maestro when it comes to creating a work of art. He truly, at the beginning of a TV show, would sit there in front of it and with a blank canvas, and by the end of the show, he has an entire painting done, and he just starts painting, and a little happy tree over here, and a little lake over here, and another happy tree over here. And oh, there's a cloud up here. Oh, I made a mistake. Let's make this into a sunset, or things like that. So Bob Ross is the kind of guy who can take something and turn it into a masterpiece. That's what I want you guys to do, to become deal experts. I want you to become deal engineers, that you can take something that maybe other people can't see, and then you could turn it into a work of art. That's truly what the intention of this is that you're able to take some framework, some ideas, and turn it into a work of art that investment partners would want to invest in. Okay, so let's talk about these S.E.R.V.E, S-E.R.V.E negotiation principles. So S.E.R.V.E stands for, the first in the S stands for sought after. So do you have a sought after deal? Do you actually have a good deal? That's the first part of one of the first things of the process, is you need to have a good deal. Okay. It's funny. I've sat there and I've had lots of conversations with people when I do my consultations, and some people, here's one of the things, and I'm actually going to make this offer if any of you guys are ever interested in that. If you guys want maybe a portfolio review, that you maybe want somebody to take a look at your portfolio, deep dive into it. If you don't have it, put into a spreadsheet or however you analyze it, I'd be happy to do a second pair of eyes on your portfolio, give you a portfolio review, see how we can optimize it, see where maybe there's some gaps, places maybe there's some equity you can tap into, and what some of the next steps for you. I would put that out there. The easiest way, if you guys are interested in having a portfolio review, I would imagine just jump into the chat, onto the comment box, type in portfolio review. I'll follow up with an instant message back to you, and I'll give you the process on how to do it. So if you're interested in doing that, be happy to do a portfolio review. Okay, but here's the thing. And talking with a lot of people and having a portfolio review, some people say, well, this property here. And I go, walk me through this property. Okay, you own it, this, that. How's it performing? Oh, it's a terrible property. It's performing just crappy. I go, okay, well, what's your plan on it? They go, well, I'm going to joint venture it with somebody. Oh, time out. If you got a bad property that you probably wouldn't even invest in yourself, why are you offering that to somebody else? Bringing somebody else onto the deal is not going to make it a better deal, okay? As a matter of fact, you're passing on a bad property that you wouldn't even invest in. You have to make sure that you have a good opportunity. That's the first thing you need to do. And you always have to think about it from a perspective of what's in it for your investor. Always think about it, what's in it for them. You are probably clear on what's in it for you. Okay, you understand real estate, but you need to first articulate what's in it for the investor, because people will come to you. People will be attracted to you if you have something of value and there's something in it for them. And here's the question is, are you known for something, right? Are you known as an expert in a certain area, in a certain market, in a certain type of property transaction? Are you known as that expert and you have a specialized knowledge? If you have a specialized knowledge, people will want to work with you. And truly, one of the things you can be, and this is what a lot of people I recommend for people, maybe when they're just getting started, maybe they don't even have a property yet under their belt and they're just getting started. You maybe don't have a large portfolio of properties, but you can become a master of a system. You can become a master of analyzing properties. You can become a master of the renovation. You can become a master of how to get financing. You can be a master of the landlording part of it. You can be a master of a system. And because you have that system, you can offer that service and help other people. Okay. And most importantly, this is one of the things that I love having the most, is if you have a team of people around you, like some of the members of my team I've been working with for 18 years. 18 years from some of my first relationships ever within real estate. I'm still working with those people today. And I've transacted many properties with this team. I have had lots of dealings, the good, the bad, and the ugly, but we've stuck it out. And here's the thing, when you have a good team and you're known as somebody, as you have a good relationship with it, you're probably going to get some of the best deals from that people. You might get some of the best services. You might be able to call in a favor or two that somebody else might not be able to do. Maybe you have a volume discount with your insurance provider because you have your volume of your portfolio. Maybe you have a volume discount with your landlord with your property management company, and your investors can take advantage of that discount without having to own 40, 50, 60 properties that you own. They can actually take advantage of that. That's how you can leverage part of your team. Okay, so the next one in the S.E.R.V.E process is everybody wins. The E stands for everybody wins. This is one of the core fundamentals that you made to make sure that everybody wins in the transaction, is you need to make sure it's fair. Now, here's the thing. Fair. What does fair truly mean? The best way I can describe what fair is what everybody agrees to. Okay? It's what you agree to, that all parties are in agreement to. That's what's fair. And that can change. It can change from deal to deal. It can change from person to person, but it's what you agree to. Okay? Now, here's one of the fundamentals I want to share with you, is whatever you negotiate in the deal up front and what you've promised to do, you need to live with it. Maybe you find that you're doing it and you're going, geez, I'm doing a lot of work and for not a lot of return on this, I negotiated a crappy deal. You have to live with it because you negotiated that. So here's what I'm actually working with somebody right now on some of their first deals. They made it really, really attractive for their investment partners in. Like significantly attractive to them. Fantastic returns, went over and above. And now he's at a point now where he's adding more deals to the pipeline. And he's now changing some of his thing to make it a little bit more fair. And he's having those conversations. He's not changing his current deals. He's changing any new deal going forward and say, here's the way the next deal is going to happen going forward. And here's the reason why. Okay. Make sure you live with what you negotiate on that as well. Now, here's a fundamental that was shared with me by one of my early mentors, Thomas Bayer. Thomas, and this one really resonated with me. And this is a conversation that I have with a lot of people that are interested in investing in real estate, and they're interested in finding investment partners. And they sit there and go, well, why would anybody want to give me any money? Why would anybody want to, partner with me? Why would anybody, I feel like I'm begging for money, something of those natures. And I usually just say, whoa, time out, guys, time out. You're offering a value to the investment partners. You're offering a valuable service. You're offering your investment partners an investment opportunity that maybe they can't do on their own. You're offering your investment partners a time saving. You're offering your investment partners some of your specialized knowledge. You're offering them something that they can participate with you. And by them winning, you win alongside them. It's a participation. It's not a them give me, I give them, stuff like that. Okay. We are participating in this deal together. All right. And then the last one here is if you share in the reward, you need to share in the risk. Okay, with that point, meaning is a lot of people are really good to talk about here's the upside. And all they do is they talk about here's the win and here's the fantastic upside and here's all the profit we're going to make. If you're going to negotiate the wins and the upside, you also have to accept that there could be some losses and you need to share in that as well. You share in the win, you share in the loss, you share in the risk, you share in the reward, which then leads into the next one of the S.E.R.V.E negotiation is risk versus reward. Before we dive into risk versus reward, we have to identify that there are two types of investors. Truly, there are two types of investors. There is a debt investor and there's an equity investor. Okay, so a debt investor is as follows. A debt investor typically is somebody who just offers up some investment capital for a loan position. What they would just probably get out of it is they would just get an interest rate on their money, and how you structure that and how you negotiate the interest rate. You can have balloon payments, quarterly payments, monthly payments, whatever the interest rate. That's typically a debt investor on the property. The second type of investor is an equity investor. An equity investor is somebody who actually owns and participates in the ownership position on the property. They might get an interest payment. They might get some cash flow payments along the way. It depends on how you negotiate it. But mostly they have an ownership position and they would profit along on the ownership position that gets negotiated. Okay, here's a fundamental that you want to understand is when there's more risk, okay, there needs to be more reward. Okay, that's one of the reasons why does Government of Canada bonds pay so low is because they're backed by the government per se, and they're perceived to have less risk. So something that has less risk has a lower return. something that might have a big risk. Maybe you have a big giant development project and there's an awful lot of things and, the moons have to align and everything has to be perfect. And, and there's an awful lot of risk that things could actually collapse on and could not work. So you need to actually offer a high return for that risk. Now, another thing that you want to talk about here too is typically liquidity is another thing that comes out in play. So something that might be a little bit more of a liquid opportunity. So let's say somebody is a debt investor and they can call that loan due at any time and with a couple weeks notice. Okay. Because it's more liquid, that means that their potential return would be an awful lot less. Expectations are for people. So I'm going to share a quick story. So I was at an event fairly recent, and it was as follows. So this person was giving a presentation. They were doing a mortgage investment corporation, and they were sharing their expected returns for some of their $1 million clients and people that put millions of dollars up into transactions. And they were sharing that, right now we're getting them on average, we're getting them about 6.5 to 7.8% return on their money. Okay, that's fantastic, right? But here's the thing: is sometimes when I talk with real estate investors and we have a potential return of 17 or 18% return that we're offering to investment partners, and you're feeling, well, that's just not enough. Well, interesting to note that sometimes investment partners, only want 5 or 6 or 7%. Okay. And you have an investment opportunity that's maybe 17, 18, 19%. Okay. Here's the thing is because it's, a one-on-one, more of a personal relationship, there is a little bit more of a risk. So there needs to be a bit more of a return. But sometimes real estate investors feel that they need to have this giant return in order to get investment partners come on here. Some people will be, it's interesting. I just did a case study with one of our students. And somebody put up a vendor take-back mortgage on one of the properties, and this person had $725,000 VTB, and their expected return was only 5% on that money, on that VTB. Okay, so everybody has a little different. That's for you to negotiate along the deal. The next one in the S.E.R.V.E process is value. Okay, so what is the value you provide to the transaction? Remember, one of the things that you're bringing to the transaction is you're bringing you to the transaction. So here's one of the fundamental truisms that you need to firmly believe is you need to develop your skills. You need to become a person of value that creates value for other people, and you are the investment partner that they're looking for. So the more you invest in your skills, the more you invest in, say, a coach or a training program or a conference that you're going to, or every book you read, and every podcast you read, everything you put in between your right ear and your left ear, and you don't watch the news to block out all that crappy news that you're hearing on a nightly basis. That's personal development work you're doing for yourself, and you're becoming a person of value. Okay. Your journey matters, like what you've done along the process of how you've come in, and maybe you've come to this country with only $10 in your pocket and you scrimped and saved and you worked your tail off and you worked 5 jobs and then you learned and you mentored for free for somebody for 2.5 years. Now you're slowly buying a property 2 on your own, and now you've built a portfolio of 7 or 8 places. That journey that you've taken along the time adds value to other people. Maybe you've been through some market swings, some ups and some downs and some in-betweens, and you've handled a market that actually dropped, and you actually developed a process to recession-proof yourself. That's part of your journey. Like, do you most people discount their journey as a value that you bring to the transaction. Now, here's the thing that a lot of people say is, you're the real estate expert. I'm going to assume that most people watching this are going to be the real estate experts. Remember, you're actually making an investment, right? You might not be writing a check, and you might not be contributing a dollar amount to the transaction, maybe, but you're making a significant investment. Every conference you go to, every book you read, all the time you put in, your coach that you hire, the training academies that you belong to, the home study programs that you do, all those things, that is your investment that you're investing into yourself. And then here's an exercise that I get people to do, but this is one of the exercises that not everybody will do. I think it's a fundamental exercise. And this was taught to me by actually working with my money partners, is we would sit there and we would, identify, and this is a very good exercise to go as we dive into the next part of the presentation. I would take a blank page like this in a book, And what I would do is I'd write me and I'd write them on each of the page, line down the middle and a line across the top. Okay. And then what I would do is I would write out every single thing I do and every single thing that they are going to do out of that. And what we're doing is we're establishing what you're bringing to the transaction. Now, guys, don't be embarrassed to say that you're bringing your time and you're bringing your expertise and you're bringing your knowledge and you're bringing your specialized skills and you're bringing your team and you're bringing, your mortgage broker that puts your application and your investment partner's applications to the top of the pile, and you're bringing your relationship with the property management, and you're bringing all those things to the table. Like, don't be shy about putting out those things and detail it. I actually get a lot of people when I coach them is we build out an entire process manual. And here's what you share. One of the best closing tools you'll have when you sit down with a money partner is you'll sit there and go, okay, well, here's what I do. Here's my manual. Here's my 27-page checklist of all the things that I do for this. Let me flip you through. I got my stuff together. I know what I'm doing. So by working with me, I'm going to give you confidence that I'm going to take good care of your investment opportunity. All right. So that's one of the things you want to do. It's build your value exercise where you put you on one side of the page, them on the other side, and you just articulate out all the tasks and duties each person is going to do. Okay, so the E in the S.E.R.V.E of negotiation stands for execution. Like, do you truly get the job done? Do you get her done, as Larry the Cable Guy would say? I think it's it's quite easy to get somebody excited. It truly is. You can have a wonderful conversation and you could say all the right words. You just follow the script that I shared with you guys last week. If you just follow that script, you will have no problem get people interested in what you're doing and get people to a point where you're qualifying. They're qualifying. It is very easy to get somebody interested. Where the difficult part comes into is fulfilling upon all the promises and fulfilling upon all those things. Like, that's why one of the biggest mistakes I made early on was I shared a lot of just the good news of what can happen in real estate. I didn't share potentially some of the bad news. I didn't share the what if, and what can happen if, and what happens if this happens, and what happens here. I didn't share enough of those things. And that was probably one of the biggest challenging things I've had is you need to tell the whole story, the good, the bad, and the ugly. And you need to prepare your investment partners that there can be some challenging times. There will be cash calls. There will be tenants that move out. There will be those things. But what your job as the real estate expert is to help mitigate each of those risks for them. Truly, I believe is the fortune is in the follow-up, the execution. You can get somebody that says they're interested. You can start having the qualification questions. Some people will say, I'm interested, and then they'll fall off the wayside. If you just keep following up and just keep nurturing people, that is truly where the fortune lies. All right. But here's the bottom line. The bottom line is just do what you say you're going to do. If you do what you say you're going to do, you should have no problem in the execution of this. Challenge can have is when you overpromise and underdeliver, right? I'm okay. It's okay to overpromise and overdeliver. I know that's a challenging thing to do, but it is okay to overpromise, but then make sure you do the work to overdeliver against the overpromise. So here is for everybody the framework. Now, when we're talking about a framework, here's what we want to do. A framework is just a process. It's just a thought process. It isn't a hard and fast rule. These things are just things that I want you to just understand the buckets of that you can negotiate. And this is just the process I go through when I'm having conversations with money partners on how I negotiate the splits. Okay, so here's the beautiful thing about the 4M framework. You only have to remember 4 words and they all begin with the letter M. So here's what I walk people through all the time is who's bringing the money, who's qualifying for the mortgage, who is the management, day-to-day operations, and then on the last M is who's the master, who is the real estate expert into the transaction. So those are the 4 things you need to negotiate. So what I'm going to do with you here is I'm going to share 4 case studies with you. 4 case studies, and each of these I'm going to just outline 4 different ways of dividing up the splits. But here's the cool thing is I want to just give you guys a thought starter. Is really what this process is to just give you guys a thought starter on how to negotiate this. And then there's an awful lot more details that you can go through. Like, quite honestly, each one of these strategies and each one of these tactical ones, I've taken time and I've built out each and every one of them into detailed case studies. Each one of these case studies in and of itself could be another hour presentation. And quite frankly, it is another hour presentation. But what I want to do today is I want to serve and add tremendous amount of value. And I'm going to give you 4 case studies and find out maybe within those 4, I bet one of them you fit within there. because I'm a firm believer in this quote. This is an amazing quote. This is a Bruce Lee quote. I fear not the man who has practiced 10,000 kicks once. I fear the man who has practiced one kick 10,000 times. So what my goal for you here, everybody, is I want you to pick one strategy and I want you to be a master at that one strategy. It's not a badge of honor to have 1,700 different types of strategies. It's okay to have one strategy and be the best at one strategy. It is totally okay for that. Okay, so here's what we're going to do. And we're going to talk about, remember those 4 variables: money, mortgage, management, mastery. We're going to break the pie up and we're going to divide the pie up between those 4 things of who's bringing what and who gets what percentage of the deal. First strategy we're going to talk about is everybody shares. This is a typical strategy that you will find. This is one that you typically find when it's family members or some really, really close friends. And this is what people typically do is everybody puts in half the money, everybody qualifies for the mortgage, everybody does half the work, and everybody is the expert on it. Now, here's the biggest thing. This is what I usually find at beginning stages with people. And I find this an awful lot when it comes down to when this is typically how family members deal with this. Everybody contributes, everybody slices the pie up, and everybody shares. Here's the main thing that I want you guys to really understand is this. In this transaction that everybody shares, everybody wins, there needs to be a leader. There needs to be a leader of the marching band. There needs to be somebody who is the expert that can make the decisions, that has the time and expertise to do that. So that's typically strategy number 1 is everybody shares, everybody wins. All right, so that typically looks fairly similar. You split it out 25% in the money, 25% of the mortgage, 20% of the day-to-day operation, and 25% of the mastery. So everybody wins, everybody shares. Okay, so the second one I'm going to talk about is what I call a typical traditional 50-50. And this looks very simple like this. This is investors typically would put up the money and potentially could qualify for the mortgage. As a real estate expert, you do all the day-to-day operations. You take all the work on. You do all the day-to-day work. Plus, you're also the team leader. You plus take on all the things for the next 15 years. You're going to be doing a lot of the work. And that's typically how this can get split. So the money's worth 35%. The mortgage qualification's 15%. The management's worth 25%. And the mastery's worth 25%. And that's a typical 50-50. Okay. Now, if you negotiate this and yours is 60-40 or 40-60, that's totally fine, up to you. What you just need to do is you need to justify how you break out and how you slice up the pie. Okay. So that's a traditional 50-50. Next one we want to do here, and it looks similar like this. As I shared, 35% is worth for the money, 15% is for the mortgage, 25% for the management, the day-to-day operation, and 25% is the mastery. All right, so here's the next one, and this is one that one of my favorites is this strategy, and this is one that you potentially already own. So let's say you're a real estate expert and you own a property, and maybe you qualified for the mortgage and you own it. Maybe you did a BRRRR or you did a flip to yourself, and I know that's a popular thing out in the S.E.R.V.E world. It's called flip to yourself. Interesting to note, I think I taught that strategy probably about 15 years ago. And I guess I should have put a little TM behind it or a strategy behind it. And it's funny, I was at a S.E.R.V.E event and they called it about flip to yourself. And I go, geez, I taught that about 15 years ago. Interesting. Very good strategy. Very good strategy with that. So here's typically one of the things you do is maybe you go out, you buy a property. You put the renovation time into it and you put a secondary suite into the property. Then you've actually got the property, you get it revalued. And then what you do is you take that property and once you get it revalued, then you bring a money partner in. So you've already owned it and you bring another money partner in. Okay, so here's one of the ways you can potentially split that out. Is the money partner, what they do is they just bring the money. If there's a mortgage on the property, right, that's already in place. The mortgage is worth 20%, the management's worth 20%, and the mastery is worth 20%, and the money is only worth 40%. So that would be a 60-40 split. Okay, you see how you can slice and dice and change this, and you're just essentially what you're doing is you're just justifying the numbers and you're just making a case for how the splits will come out. This fourth one is one that if you guys are a full-time real estate investor, that's what this fourth case study is. Let's say you're now gone full-time into the business of real estate investing. Typically, one of the things you're going to need if you're full-time in the business is you're going to need to get an income source from this. You're maybe going to need to charge fees, disposition fees, administration fees, management fees. You're going to have to get something out of it. So now you're a full-time investor. This is also typically what you will find more prevalent in the multifamily world. When you start talking about apartment buildings, these are the typical type of splits you'll find in apartment building. So here's what you do as investors. So an investor will sit there, they'll bring the money and they'll qualify for the mortgage. And you as the real estate expert, you're going to bring the management and the mastery. But one of the things you're going to charge to the deal is you're going to charge some fees. You're going to charge an acquisition fee. You're going to charge maybe a disposition fee, and you're going to charge maybe an administration fee. Now, those numbers range anywhere from some people I know charge like 1%, some charge 3%, some charge 4% of the management and the acquisition fees, but that's for you to negotiate on there. So what you're doing as the real estate expert is you're willing to forego a little bit of an ownership position to take some monthly fees to help cover the costs of you as a full-time investor, because you need to make money as from your real estate operations in order to keep moving forward. You need to feed the family. Okay, so you start charging fees. Now that's a more prevalent role when it comes down to a lot of the time when it comes into multifamily, and it's a little bit more of an advanced. And you as the real estate expert, remember, you're at full-time and you're charging fees, but you better be more of an expert when it comes to it. You better have a few years under your belt. You better have multiple transactions. You are now becoming an expert in the transaction. All right. Okay, so that's how that typically splits out. 50% is the money, 15% is the mortgage qualification that goes to the investment partner, 20% and 15% go to you as the real estate expert, but you're also charging an acquisition fee, a disposition fee, and an administration fee on a monthly basis. Okay, so that's what we're going there. So here's what we're going to share here. So that's what we talked about here is really my main intention, and I wanted to keep it under an hour, and I want to actually open it up to some Q&A here, is I wanted to just give you the framework, okay? For you now, and here's the conversation I have all the time when I have consultations with people. Here's the conversation they say is, well, how do I structure this deal? Okay, well, let's just break it down. Who's bringing the money? Who's qualifying for the debt? Who's the day-to-day operator? Who's the expert? Right? Those are the four variables. And then what I would just sit there and I would ask the question is, how much is each of these worth? In some cases, maybe the mastery and the management, let's say you're taking on a big giant development project, the mastery and the management are huge components of the pie, right? Then whoever's doing that work needs to get more. If you're just getting a house on the MLS, all right, and you don't have to take a lot of time and effort onto the finding of it and the team. Okay, so then what you want to do is maybe that's worth less. It's a little bit of an ebb and flow of that, but really what I want to do is just take something that completely has no framework. I want to put a frame around it, and now what you can do is you can give some consideration to each one of those four variables, and those four variables all need to add up to who's bringing what, and they all need to add up to 100%. I have 2 free gifts that I want to offer to you guys if you're interested in these gifts. Number one is we did a webinar where we walked through a $725,000 vendor takeback on how do you use vendor takebacks to get the capital to close on a deal. Wonderful case study on how to find the property, how to build a relationship, how to educate the seller, and then how to execute on it. So I'm going to offer that to each and every one of you. The second one is last week, I gave you guys an option to download a script to help qualify your investors. And it comes also with another training video. Hope you guys have yourself a wonderful day. And I'm going to sign off the way I usually always sign off is, ladies and gentlemen, in every interaction you ever have with another person, make sure that that person leaves feeling inspired, encouraged, and always come from a place of love. I sure hope you enjoyed this in-depth training video. If you want to continue your education, continue your learning, I've created a playlist for you. Over here, if you just click the link over here, there's a playlist for you that will take you to an entire series of in-depth training material. So just click on over here where Baby Yoda is. Use the force, click the link, and you'll be taken directly there. Thank you very much.